Hi, welcome back to Ox Talks. It is October 10th, 2023. I want to cover the topic of this unfolding housing nightmare today. I have a couple of articles I want to share with you that I saw yesterday. And then what I'd like to do is extrapolate that and tie it in with an issue that I see come up fairly often with regard to seller financing, when a seller carries the paper or agrees to act as the bank, if you will, for a buyer in a real estate transaction. So hope you enjoy today's show. This article is out of Fortune from yesterday. It says the U.S. housing market has gotten so expensive that income would have to jump 55% to make buying affordable. Real estate executive says personal incomes would have to soar to make up for the higher home payments created by rising mortgage rates. There's one undeniable fact about the U.S. housing market. It's just not affordable for the vast majority of potential home buyers. With mortgage rates hitting a multi-decade high at 7.49%. And by the way, that's if you have really good credit and you have a standard down payment available to you. If you have less than stellar credit, if you can't come in with 20% down, you're going to be paying a higher rate than that. This is Andy Walden, Vice President of Enterprise Research for ICE Mortgage Technology, has done some calculations. As a Vice President of Data and Analytics for years with real estate data firm Black Knight, Walden knows the mortgage market inside and out. And he led to the creation of a monthly mortgage monitor that breaks down trends in the housing finance. He calculates that U.S. income would have to increase a whopping 55% for the housing market to be considered affordable. It says, quote, if you look at home affordability itself and what it would take to normalize the market today, he told Kelly Evans of CNBC's The Exchange, quote, it's a 35% correction in price or a 4% decline in mortgage rates or a 55% growth in income or some combination of those. How many of you think that there'll be a 35% correction in price, a 4% decline in the mortgage rates, or a 55% increase in your income? I think either one of those is highly unlikely. It says, for reference, Americans earn an average of $4,600 per month, according to August 2023 data from CEIC. However, 1/4 of new buyers are paying at least $3,000 in average monthly principal and interest payment on a 30-year fixed rate loan as of July 2023, according to Black Knight. For some buyers, that's a difference of $800 to $1,000 per month more on mortgage payments. Plus, some homeowners could be spending more than 60% of their paychecks on their mortgage alone. As a result, fewer hopeful home buyers are hitting the market. It says, while it's easier to understand that high home prices continue to lock potential buyers out of the housing market, another problem is the lack of inventory. There's been a very slight increase in new inventory listings according to Zillow, but it's unlikely to be enough to ease the pressure on new buyers. This shows some signs of recovery when compared to the 12.7% year-over-year decline versus 25.6% year-over-year decline in July. The next article that I came across I thought was interesting is from Newsmax yesterday. And it says the frozen housing market could be on the brink of shattering again. It says back in 2007, the housing market froze up. The combination of a speculative bubble in home prices nationwide collided with a 5.25 effective federal funds rate. And then the housing market shattered, the article says. History is repeating itself before our eyes. Today, the housing market is definitely, says, in the freezer, and it sure looks like it's on the verge of shattering again. And the article goes on to talk about the warning signs. It says, now, with homes, as with any other large purchase, credit is an absolute necessity. Only the top 2 to 3% of the wealthiest households in the United States are likely to have the cash on hand to purchase a home outright. It says last year, lenders denied loan applications due to insufficient income more often than any other point since records began in 2018, according to a new report from the Consumer Financial Protection Bureau. It says overall, 9.1% of home purchase applications among all applicants were denied in 2022, the Consumer Watchdog Agency reported. Higher than 8.3% in 2021, but a marginal decrease from 9.3% in 2020. Refinance applications were more frequently rejected at a rate of 24.7 in 2022, and that's up sharply from 14.2% in 2021. It says the median American household would need to spend 43.8% of their income to afford the median priced home. That's the highest percentage in history, worse than the peak of the last housing bubble. It says part of the problem is the astronomical surge in home prices, which rose some 40% over the last 3 years. It says not just the home prices that are problematic. Obviously, it's also the mortgage rates, and they have more than doubled since the beginning of the pandemic. With mortgage rates so high, home buyers inevitably have less purchasing power. Those of us who are currently locked into a sub 3% mortgage definitely don't want to refinance given today's much higher rates, it says. And then lastly, it does mention renters. It says, unfortunately, for renters, they're not much better off these days. For the first time in decades, the rent to income ratio has reached 40% at the height of U.S. inflation, marking one of the least affordable rental markets ever. And it says that's not a good place to be. So we have a really, really difficult and challenging situation for buyers. And therefore you have a challenging situation for sellers as well, because they're going to have a tough time selling their property, and they're going to have to either keep slashing their asking prices to simply get it moved or find some other alternative. One thing that comes up in my practice quite often is a concept, an issue of seller financing, or a seller carrying the paper. And what that means is a seller basically acts as the bank for a buyer. And instead of being cashed out at the close of escrow, a seller will receive a promissory note from the buyer promising to pay the purchase price of the property. And in California, the seller will also receive what's known as a deed of trust. That's distinguished from a deed, which is a title document. Deed of trust is basically the document that confirms that the loan is secured against the property, and it's recorded in the local county where the property is located. So in essence, the seller is agreeing to be the bank for the buyer. This often comes up when you have a buyer who maybe has less than stellar credit. You have a buyer that cannot therefore go to a standard bank and obtain a mortgage. And maybe you have a buyer that just simply wants to take advantage of a seller that feels compelled to move the property at all costs. And that's going to come up as you see this market continue to decline. Obviously, every seller needs to have their own legal counsel and evaluate the situation in their given jurisdiction. But what happens if a buyer thereafter falls on hard times and simply can't make the payment on the promissory note to you as the seller? What happens if the buyer believes the property is losing value at a rapid pace in relation to what the buyer owes to the seller and decides to stop making the payments? What does the seller do at that point in time? The seller is no longer a seller. The seller has conveyed title to the buyer, and the seller is now simply the bank. The seller can't go and just lock them out. They can't go and just kick them out of the property because the buyers own it. They're on title. So what does the seller have to do? Well, the seller has to go and get a lawyer, and oftentimes get a title company involved to initiate a foreclosure process. a legal process to take the property back because the buyer has defaulted on the loan. The same way a regular bank would do if you stop making your mortgage payments. What does that mean? Well, it means that the seller is incurring costs, legal fees. It takes several months or more often to complete that process. What happens if during this period of time the buyer damages the property, either intentionally or unintentionally? What happens if the value of the property during this process continues to plummet and you're losing value while you're trying to foreclose on a defaulted loan? All of these things are things that a seller looking at or considering carrying the paper or agreeing to seller financing should consider. And you should consider these things if you're a seller before you sign the contract, before you close the escrow. So many times I have a party come to me or a client come to me and says, well, I agreed to carry the paper for this transaction, you're not paying me, what do I do? Well, there are very limited options at that point. You have to comply with the law in your state and pursue, a foreclosure or other remedies. And there are things that I've seen, games that buyers can play and seller carryback transactions to delay that process. They can file bankruptcy. They can, like I talked about before, they can cause damage to the property. So as a seller, even if you feel like this is your only alternative, get a lawyer involved, do your due diligence. Again, when you're evaluating this kind of a transaction, you're looking at it as the same as a bank would look at it if they were looking to make to lend a buyer money to buy a house. You have to look at the buyer's credit history. You have to look at the buyer's debts and obligations. You have to look at the buyer's other assets. If the buyer stops paying, are there assets to other assets that can satisfy the debt or obligation? So I hope that you understand that that's one thing that will often come up if you own real property and you're selling real property. For a buyer, a lot of times it might make a lot of sense if you can get a seller to act as the bank for you. It can sometimes streamline the transaction, and just be wary. Just everyone do their due diligence. If you're a seller and you're in escrow, and it's a seller carryback transaction, at the last minute, the buyer wants to assign the contract to a newly formed entity that has no track record. These are all kind of things that you should be aware of. Your realtor can supplement the process, but get a good real estate lawyer to look at these issues for you. I saw I was coming to the office today, and I was pulled up behind a truck, and it was a roofing contractor, and he had his name of his business on his truck and his license number. And there was a really cool bumper sticker I saw, and it says, "I am a roofing contractor. What is your superpower?" And I thought that was very cool, and I thought it was appropriate to raise today, because we talk about building, your arc, forming your own business, be able to provide for yourself and for your family, and to control your income stream to the extent that you can. And so my question to you today is, what is your superpower? Everyone has one. Everyone has a skill set. They have strengths that they can employ and deploy in this current environment to make themselves better and to create a solid financial situation for them and their family, and to create some autonomy. Lastly, in closing, I hope you guys are getting your half an hour of exercise in today. Get your walk in today. Get your push-ups in. Get some sit-ups in. Drink your water. Stay hydrated. We need to stay healthy for what's coming. So I hope you enjoyed the show. Till next time, thanks.